The activities of foreign institutional investors, FIIs, and domestic institutional investors, DIIs, significantly influence financial markets. Understanding their seasonal buying patterns can provide valuable insights for investors. This article reveals some lesser-known facts about these patterns and their implications. FIIs, foreign institutional investors. Tax year effects. FIIs often adjust their portfolios at the end of their fiscal years, which might not align with the calendar year. For instance, many European and Japanese institutions have fiscal years ending in March, leading to increased activity in February and March. Currency influence. Seasonal fluctuations in the foreign exchange market, like the strengthening of the US dollar during certain periods, can influence FIs' investment decisions. A stronger dollar might make investments in emerging markets more attractive. Earnings seasons. FIs tend to increase their buying activity during earnings seasons, especially in Q1 and Q4. Positive earnings reports and forward guidance often lead to increased inflows. Global events. Major global events like the annual World Economic Forum in Davos or significant geopolitical events can lead to a spike in FI activity as they adjust their strategies based on new economic outlooks. Quarter-end rebalancing. FIs often rebalance their portfolios at the end of each quarter, leading to increased buying or selling activity. This is driven by the need to maintain certain asset allocation targets. DIIs, domestic institutional investors. Fiscal year-end adjustments. In countries like India, where the fiscal year ends in March, DIIs often ramp up their buying in March to meet their year-end investment targets and manage tax liabilities. Budget announcements. DIIs tend to increase their buying before and after the annual budget announcements. Anticipation of new policies and adjustments based on the budget's impact on different sectors drive this activity. Dividend seasons. DIIs, particularly mutual funds and insurance companies, often increase their buying in stocks that are about to pay dividends. This typically happens in Q4 and Q1 of the calendar year. Festival seasons. In markets like India, the festival season, October to December, sees increased D2 activity. This is partly driven by the belief that consumer spending during festivals boosts corporate earnings. Monsoon influence. In agrarian economies, DIIs might adjust their portfolios based on monsoon forecasts. A good monsoon season often leads to increased buying in agriculture-related stocks and sectors that benefit from rural spending. General observations. Holidays and market closures. Both FIs and DIIs adjust their activities around major holidays and market closures. For instance, trading volumes often dip before long holiday weekends but pick up immediately after. Window dressing. Towards the end of financial reporting periods, both FIs and DIIs might engage in window dressing, where they buy high-performing stocks to improve the appearance of their portfolios in their reports. Sector rotation. Seasonal changes often lead to sector rotation. For example, FIs might favor technology and consumer discretionary stocks during holiday seasons due to expected higher consumer spending, while DIIs might focus on defensive sectors like utilities and healthcare during uncertain times. Recognizing the seasonal buying patterns of FIs and DIIs can provide an edge to investors. By aligning strategies with these institutional behaviors, one can navigate market complexities more effectively. Stay informed and make the most of these insights.